Hey guys, what's up? Welcome to another episode with me, Shashank Godappa. And now I'm assuming you have reached a point in your career where you might have got some bonus from your salary. And if not bonus, you might have got some amount of extra money in your salary today that you want to invest. Now, I know a lot of people have this question that Shashank, where do I invest my salary or where do I invest this bonus that I get at the end of the year? Now, most common thing that everyone would say is, okay, you know what, bonus aa gaya, so let me go buy one stock or let me go invest in my mutual fund. And that is one mistake that a lot of people do. So today I'm going to quickly explain to you how I would invest a bonus that I get as of today into the market as well. So let me quickly share my screen and let's go deep into it. Now, let's assume I have got a 1 lakh rupee bonus. Now, as I said, a common misconception people say that whenever I get a bonus, I will put all that money in one stock or in one mutual fund. That's a big mistake, right? Because you have worked very hard for the last 12 months and you have got a bonus. And I would suggest keep 25% of that aside for you to spend. Because I have done this mistake in the past where I get a bonus of, let's say, 1 2 lakhs, I invest everything, and then suddenly one big expense come. Again, I remove that 1 2 lakhs. Out of that 1 2 lakhs, I remove 40 50,000 for the expense. Whole compounding is gone. I have lost money on different fees, exit loads, etc. And eventually, I don't make a lot of money on that perspective. So keep that 25%. Whatever you get, 1 lakh, 2 lakh, 10 lakh bonus, whatever you've got, keep 25% is your lifestyle bucket. Do whatever you want with it. Absolute guilt free. Enjoy, buy whatever you want, go away, go abroad, go India, wherever you want to do whatever you want with this 25,000. Remaining 75,000 is where I come in to help you on investing purpose. Okay. So where will we invest this 75% for long-term wealth creation? Now I have broken down into buckets. Okay. So bucket number one, I told you, is lifestyle, 25,000, do whatever you want, trip, sneakers, gadgets, whatever you want. Second is equity mutual fund, not stocks, equity mutual fund. Now, I would strongly suggest, because I have this also philosophy that a lot of people who invest in the stock market are not very good at it, right? Either you have recency bias or survivorship bias, where you believe you are very good, but you are not very good. And over a long term, you will realize that you are not very great on it. So I would always suggest whoever is investing in the market, have at least a 50-50 allocation. Let's say you want to invest in the equity market as an asset class, I would say at least have 50% in mutual fund and 50% in equity. No problem, right? If you're wrong, mutual fund will save you. If you are great, mutual fund is still going to get you returns, but you will make more returns here. So you don't lose in either of the situation. The problem I have seen with a lot of people, they put all their money in equity funds, not mutual funds, equity assets, and they are wrong most of the time and they lose a lot of money because they don't do a lot of research. You have a job to focus on. So I would say the bonus money that you get, put it in a mutual fund. Now comes the question, what type of mutual fund? So there are three places where I would recommend. One is into a flexi cap fund, okay, which is a diversified flexi cap fund. I would not put this in a small cap fund. I would not put this in a mid cap fund. Either a diversified flexi fund or an index fund, so that it is low cost. I don't have expense ratios. Or I would just put it in a large cap fund, whether it's active or index, does not matter. But you see the risk profile I'm keeping here very low, either flexi cap, large cap, or index. I would not go into small or mid. And I know a lot of people, what they do over here, as I call it, wealth destroyers. They get money. I know they go and put it into a small cap or they will put it into a micro cap. Do not do this, right? You worked very hard for this and don't do it without thinking. This is something that you want to compound. So either a large cap company, I would suggest if you're putting it into a company, put it in a large cap company. I would say better is to ideally put it in a large cap mutual fund, flexi cap fund, or an index fund. That is much better. Okay. Coming to bucket three. Now, bucket three, bonds. Now, this is something I believe most of you guys don't do. One of the biggest wealth destroyers as of today, I would say, is people not investing in any fixed income assets. Everyone believes that we should be full all in on equity, and I think last 2.5 years is a clear testament that you should not be all in into equity, right? So I would put 25,000 rupees of this money into bonds. That is 25% of that 75%. So 75,000. So 75,000 that we're investing out of my bonus, 25% I'm enjoying, 35% I'm investing in equity. Okay, so I still have 35% exposure into equity. 25% I would go into fixed income instruments. As I said, If the market is bad, you make money. If the market is good, you are still in equity, so you would still make money. So there is absolutely no problem. Go for asset backed bonds. I will explain a little bit about this because some of you guys don't know. And aim for a return range of 9 to 12% in bonds, because that should beat your inflation, and post tax returns should also be great. And horizon would be, let's say, 3 to 2 years, 3 months to 2 years in when you invest in bonds. That is basically what I would focus mostly on in this perspective, right? Now, again, for all the people who don't know, I'll explain what a bond is. So a bond is basically a loan that you as an investor give to a company. So I'll give you an example. Let's say Tata Capital or any NBFC that raises money to grow their business. They will take money from you and they will say that every year I will give you a fixed amount, 7%, 8%, 9%, 10%, 11%, 12%. I will give it to you every year. I will take that money and maybe I will take from you at 8%, 9%, and maybe I will lend at 15, 17%, and I will make a spread over there. Maybe I will put it into a data center and make money there. Maybe I will expand my manufacturing capacity. I will make money there. So that is what they will do. And basically, what you should be focusing on is something that has a good name and is asset backed. It is backed by some collateral, right? So that is something I would really focus on. That is where the game is, right? Now, bonds were always built for institutional investors, and it is the favorite playground of institutional investors. And this used to happen in the past where retail investors did not have a way to enter because the minimum ticket investment for a bond was 10 lakh rupees in the past. Now, because of changes in SEBI regulations, it has become easy to invest in bonds, and platforms like Wintwealth have been able to carve out a space in this market. I obviously have some bonds that I have invested in Wintwealth as well, so good disclosure there. And Wintwealth is basically a SEBI registered broker. They have got their broking license to operate as a bond platform, and that's a platform that gives retail investors access to asset backed bonds. Okay, asset backed bonds. We would not like to go into junk bonds. We would like to be in asset backed bonds. Now, what is asset backed bonds? These are bonds that have some collateral backing. They give an effective net return of 9 to 12% per annum fixed. It's fixed income instrument, right? Here you can start with 1,000 rupees. So you don't have an entry barrier like as if you have to invest with 10 lakhs. You can start with as low as 1,000 rupees and you can start investing very fast. Now, the third problem or misconception people had with bonds is that, Shashank, they are illiquid. You cannot exit the bonds because you have to keep them for 1 year, 2 years, or 3 years whenever the maturity is there. So that also has been solved here. They have something called short-term options. Short-term bonds, short-term options are also there. And you can find bonds over here, which is even 3 months to 6 months, right? So you don't have to always go for a 1 year, 2 year, 3 year bond like the HNIs. You can actually do something where you can invest for 3 months or 6 months and you can get your full principal interest back at the same rate of interest as well. So that is also there. You don't have to wait for 5-10 years as well. And fourth is liquidity. If you suddenly need the money, for example, before the bond matures, which is one of the biggest problems a lot of people have, you have the option to sell before maturity. That option is there. But again here, if you want to sell early, then the prevailing interest rate at that point will apply. So that might be some problem there, but everything is possible is what I'm saying with liquidity. So for me, if you include bonds, which is you can do it via Wintwealth because it's a trusted platform that even I use. If you use that in the mix, then it definitely makes sense. And this is something that most salaried investors skip. And I would honestly say you should not skip it. I would rather suggest you look at it from a very serious standpoint as well. So if you want to know more about bonds, you can check out. I'll put the link in the description for all of you guys to look at it. Now, what is a bond destroyer? If you go and buy any kind of junk bonds or bonds with extremely poor credit rating, they might show very high returns, then you are in a big problem. As I said, you focus on asset-backed bonds, you will be absolutely fine. Now coming to the fourth one, which is gold. Now I know our Prime Minister has come and also said that we should not buy gold, but I think gold should continue any format. It can be in the ETF format is what I would prefer, digital and ETF format, because if you go and buy physical gold, you will be wasting a lot of money on making charges and GST. So I would start putting some money into ETF. Now think about it from a very logical standpoint. You've got a bonus. You have put the money in equity, you have put the money in debt, and you have put the money in gold. There is no way you can lose in the long term because you have covered all three classes. You have covered the gold, you have covered the bonds, you have covered mutual funds, equity also. So whatever happens, market falls, gold and bonds will save you. Market goes up, gold bond to वैसे भी is there, equity will save you. So you will make a very balanced approach of investing where you can be little stress free. And this is why I say a lot of people do this mistake of just buying on small cap company or putting it into a micro cap. They will lose money and stress बढ़ जाता है वो time पे. Okay, and here I would put 10% allocation in this. And then finally there is one more, which is emergency fund top up. This is optional. If you have an emergency fund and you feel you don't need to top up, don't do it. If you feel you need to top up, do it. But this is again optional. If you feel that you don't want to do it, the same 5,000, I can either go buy more into equity or buy another bond of 5,000, because both are higher income asset generating classes. Gold, I would say, has also run up a lot. So bonds, at least you will get 9 to 12% fixed. And if you believe that the equity market is going to be bad for another 1.5 years, then you can put it in bond. If you believe equity market might be better, you can put that last 5,000 into the equity. So I'll leave it up to you. But what happens here is, it is beautiful because you are now invested across 3 different asset classes. Equity is also there, bonds are there, which is another asset class, gold is also there, which is another asset class. All 3 are not correlated to each other, right? That is where you win. Now, if you want to do it in a smart way, this is what smart people do. This is what HNIs do. If you open any HNIs portfolio won't be micro cap and small cap. It will be a diversified basket as well. So if you want to reach that point, again, it's all up to you. But my job is to come and teach you how to do things. I know when you get your bonus, it is very tempting to go and increase that lifestyle bucket. Instead of 25%, you want to go buy an iPhone. In the early days, don't do that. Save as much as you can. In fact, now more than ever, you need to save as much as you can. You want to buy equity, bond, gold, do it in whatever ratio you feel is good. I have made this ratio for you. But if you feel you want to change the ratio, you do it in whatever ratio. Ratio is not the game here. The game is you have to be across different asset classes and have a diversified approach to life. If you do that, I don't think you will lose in the long term. Again, I hope you guys enjoyed this video and liked this video. And if you did, please put a like. All I'm asking for is a like. So just like that video and comment down if you have any doubts or questions. I will personally answer all of this. Again, thanks a lot for watching this episode. This is me, Shashank Goduppa, signing off. Take care. See you. Bye-bye.